Lecture covers Chapter 10 of your textbook, Fundamentals of Financial Management. With the introduction of the Healthcare Reform Act in 2010 and its stated objective to rein in costs, the importance of understanding the unit cost structure and efficiencies of the average for-profit clinical laboratory becomes a critical necessity. In today's managed care environment with ever-increasing governmental regulation, the laboratory manager must have an understanding of the complex relationships between and among costs, productivity, and revenues. An understanding of the financial and economic environment of healthcare is a critical component in the decision-making processes of the laboratory manager. This lecture introduces the reader to the aspects of the fiscal and organizational environment of the healthcare industry as they relate to laboratory managers. Following successful completion of this chapter, the learner will be able to discuss the importance of financial management in the healthcare industry, identify the different types of organizational business operations, identify and interpret basic financial statements, compare and contrast financial and managerial accounting, recognize revenues and expenses involved with laboratory operations, explain basic performance tools and ratios used by management in forecasting performance and in the decision-making process. Briefly discuss budgeting and the way it relates to revenue and expense management. Explain how to use a cost volume profit analysis. Understand the behavior of laboratory costs. Explain the costs associated with laboratory testing. Explain how to analyze laboratory costs. Explain how to derive and use cost per test analysis. Healthcare facilities operate in a variety of business environments. Many are public sector activities maintained by local, county, state, or federal entities. Others function as private sector activities and are owned or managed by persons or organizations in non-governmental organizations. While these operations may generate a substantial portion of their income from government sources, they remain private. A not-for-profit company is not automatically immune from a responsibility for paying federal and state income tax, while an exception will ordinarily be granted by the Treasury Department. A not-for-profit organization will continue to be liable for state and federal income tax on earnings it may earn, which are outside of the scope of its non-for-profit status. Private healthcare facilities may take different forms. They can be created as a proprietorship, which means that it is owned and operated by a for-profit entity. A partnership is an entity owned by two or more individuals with joint and several responsibilities for debts and obligations of the organization and a defined manner in which gains and or losses are to be shared. A corporation is a legal entity and has an existence of its own apart from its stockholders. A primary goal of the financial management is to ensure the profitability and the survival of the organization. In contrast to the financial accounting system, managerial accounting analyzes the information to make it useful for budgeting, decision-making, and organizational evaluation. Balance sheet, a document that represents the financial position of an organization at a particular point. typically the end of an accounting period. The balance sheet reflects an organization's assets, liabilities, and equity. Assets represent the resources of the organization. These assets can have a physical form, such as a building, or may be intangible and have economic value. Liabilities, the obligations that an organization has to creditors. This may be short term, due in 1 year or less, or long term, greater than 1 year. Owner's equity, the book value of an organization. Retained earnings represent the company's earnings over time less any dividends distributed. In a not for profit organization, the equity will be represented by either the terms net assets or the excess of assets over liabilities because such an organization has no capital shareholders. Financial accounting concepts. Income statement presents the financial results of an organization over a stated period of time. It is important to consider whether an organization is for profit or not for profit. In a for profit organization, this will be referred to as net income. In a not for profit organization, this will be referred to as excess revenues over expenses. In accrual accounting, revenues are recognized or reflected in an income statement when they are earned, not when they are collected. Expenses are recognized or reflected in the income statement when they are incurred, not when they are paid. In cash basis accounting, revenues are not reflected until the cash payment is received, and expenses are not reflected until payment is made for the purchase. The cash basis system may not reflect an accurate picture of actual operations since it is heavily skewed based on payments received or paid. It is not considered a valid representation of an organization's financial position. Revenue reflects the earnings of the organization, both collected or yet to be collected. Expense. Expenses or costs are recognized as charges to the income statement as they are incurred. Inventories. Inventory represents the value of merchandise that has been purchased for resale, but at the date of the financial report is unsold. Property, plant and equipment. PP&E represents assets that have been purchased that are to be used in the revenue producing activities of the organization. When purchased, they are capitalized rather than expensed, meaning that their cost is assigned to the balance sheet rather than the income statement. Their cost is then recaptured or charged off by periodic charges of depreciation, which allows for their cost to be absorbed in the income statement over a period of years, usually consistent with their estimated useful lifespan. Accrued liabilities represent the accumulation of costs which have been incurred in operations but which are not yet due for payment and thus have not been reflected as accounts payable or cash disbursements. Depreciation represents the periodic charges of cost to recapture the value of property, plant, and equipment items that have been purchased and assigned to the balance sheet as long-term assets. Depreciation over a period of time, consistent with the estimated useful life of the item, reflects a better matching of the revenues attributable to the use of the equipment with the cost of the equipment over time. Accumulated depreciation. As depreciation is charged as a periodic cost, an offset is necessary to absorb this expense. The accumulated depreciation account serves to act as an offset against the PP&E accounts and thus reflects both a gross cost and a net cost of capital assets shown on a balance sheet. Tax issues. While accounting requirements require that equipment costs be recovered over a periodic basis, current tax regulations allow for the cost of equipment to be absorbed in the year of the purchase. Cash flow statement required as part of the financial statement for a for-profit company. This statement reflects the flow of cash through an organization over the period and is segmented in three distinct categories: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Notes to financial statements. Presented as an addendum to define or qualify items in need of clarification for a broader understanding of those items in a company's financial report. Typically, they will specify that the reports have been prepared on an accrual basis, a modified accrual basis, or a cash basis. Annual audit. An annual audit may or may not be required. An annual audit is completed to obtain reasonable assurance that financial statements presented are free from material misstatement and that effective internal control has been maintained. This does not attempt to report that everything is precisely accurate. Internal control systems. Systems and procedures that are designed to maintain a proper flow of information, reduce opportunities for mistakes, and preclude deliberate acts of fraud, theft, or defalcation. As an example of proper internal control, a person who is responsible for purchasing should not be the same person who prepares checks or who reconciles the bank statement with the company's records. Operating managers depend on a variety of sources to keep abreast of the performance of their activities. Among these are periodic financial reports, typically generated monthly or quarterly. This will usually include an income statement, a statement of assets, liabilities, and equity, budget projections and comparisons to actual, and various statistical performance reports. Other activities that need to be tracked include revenues, balance sheet, ratio analysis, return on investment, and internal ratios. The aggregation of gross charges will be reflected as the lead item in the income statement, followed by the accumulation of discounts granted, contractual allowances awarded, and any other credits that are recorded as a reduction in revenues. The income statement will then show a gross revenue accumulation, an additional line for total contractual allowances, discounts, etc., and a third line for the difference between the above designated net sales. This will be the level that must be referred to when planning for expense or cost provisions. Balance sheet and ratio analysis. Financial ratios can be categorized in three distinct groups: liquidity ratios, debt equity ratios, and profitability indicators. Profitability ratios, such as the ROI ratio, demonstrate the organization's efficiency of operations. The return on investment ratio is one of the important profitability ratios. A rate of return ratio is used to evaluate the operation of the organization as a whole by comparing net income with the organization's total equity. As an example, a net income of $13,980 compared with a total equity of $342,295 results in a 4.08% return on investment. Please review Table 10-3 for a list of ratios commonly used in financial analysis. In addition to financial ratios, the laboratory manager can also develop internal statistics that can help to control costs and evaluate operations. Much of the data needed to develop these internal ratios can be derived from the accounting system. Example of ratios important to the laboratory manager are cost per test, total cost per billable test, direct cost per billable test, technical labor cost per billable test, billable test per labor cost, billable tests per patient admission, revenue per billable test, profit margin per billable test. Financial management is the process of planning, controlling, and evaluating available fiscal, material, and personnel resources of an organization. The goal of sound financial management is the proper and efficient allocation of these resources within the laboratory and the application of ongoing improvements to ensure quality, efficiency, and cost effectiveness within the laboratory. Equally important is the manager's involvement in the planning process and control of operations through sound internal planning and proper budgeting, which can be optimized through the use of budget performance reports, cash flow projections, and the use of SWOT analysis. This figure depicts the relationship between management and accounting functions. A universal tool that is used in business to guide an activity and plan or provide for the needs of the activity in a well-formulated and comprehensive budget. Budgeting is a system for formalizing in writing a quantitative financial plan supportive of the institution's financial mission for a given time period. Budget, performance report, comparison of actual expenses with projected budgeted expenses provides important information to the laboratory manager and helps to evaluate the original projection of available resources for a given period. The manager must pay close attention to and scrutinize the variances between budget and actual expenditures. Please review tables 10-4A and 10-4B, which are examples of budget comparison documents. A negative variance on a revenue account indicates an unfavorable variance because the revenue was less than expected. By contrast, a negative variance on an expense account indicates a favorable variance because the cost was lower than expected. The opposite effect is also true. Cash flow projection. While the operating budget is necessary to maintain the activities of the organization on an ongoing basis, an organization must also plan for proper cash flow to assure that ample resources of cash are available to meet obligations. Please review Table 10-5 for an example of cash flow projection budget for a profit laboratory. Although subjective in nature, an analysis to determine the strengths, weaknesses, opportunities, and threats facing the organization may give a different view from that presented in the budget process. SWOT analysis is the result of comprehensive planning, including brainstorming sessions among managers and employees to anticipate future events that may have an impact on the organization. The costs of adhering to requirements mandated by accreditation and certification agencies must also be considered along with traditional costs such as labor, materials, and depreciation. Since fixed costs are not increased or decreased by volume, the per test fixed cost will change in an inverse proportion to volume and thus represents a measure for the laboratory's economies of scale. For example, if the lab has $10,000 in fixed costs and performs 1,000 tests, the fixed cost per test is $10. If, however, the lab completes 10,000 tests, the fixed cost per test drops dramatically to $1 per test, making the lab more cost competitive. Variable costs are those that move in relationship to the laboratory's testing and change in a direct relationship to the volume. Supplies required to perform a specific test are variable costs. Managing variable costs require an understanding of both the type and cost the inputs used to conduct a test, as well as the normal usage of the materials. Two formulas can be applied to areas such as labor hours and prices of supplies, price variance, and quantity variance. These costs change in increments based on workload or volume change. This figure represents a cost behavior graph. The bottom straight line represents the fixed cost, and the top line is the total cost, which equals the FC plus the variable costs. For an effective analysis of both unit costs and total costs, the laboratory must address both fixed and variable components of cost behaviors. Cost behaviors will vary in relationship to the laboratory's testing volume. This figure is an example of a high-low graph. The graph shows a relationship between the two variables, namely, the utility cost and the number of tests performed. A cost formula that determines the levels of fixed and variable costs can then be used to estimate or budget future costs. The long line represents the relationship between test and utility cost with the slope equals the estimated variable cost per unit plus the estimated fixed cost, which are represented by the point where the line crosses the y-axis. The cost formula or relationship derived by this high-low graph is y equals fixed plus variable rate times number of tests. Using the information presented in Table 10-7 of your textbook on page 258, what will be the month's estimated cost for utilities for January of the following year if the test volume projected is 100,000 tests? Work through the calculations on page 258 of your textbook. Understanding the cost behavior of the laboratory allows the manager the opportunity to analyze the position of the lab with respect to profitability and to determine what measures are needed to control costs. One of the primary tools for completing this analysis is cost volume profit analysis, more commonly called break-even. Please review Table 10-8 on page 260 and the calculations of CVP on page 259 to answer the following equation. If the lab charges $15 per test, When the variable cost is $9 per test and the fixed costs are $300,000, how many tests need to be completed to cover the lab's fixed cost and break even? This figure is the graphic representation of the CVP analysis of the question presented in the previous slide. In order to complete a CVP analysis, it may be necessary to identify and allocate the various costs to the services being rendered to determine the cost per test. A cost per test analysis begins with the identification and allocation of component costs and their identification and relationship to the services provided. The unit cost per test is used to measure the laboratory's productivity and demonstrate the laboratory's economies compared to other comparable laboratories. Generally, the lower the cost per test, the more efficient the laboratory is in providing its services. The cost per test equals the sum of both fixed and variable costs divided by the number of unit tests. Costs are often shared with other tests and thus will need to be allocated by some standard measure. In this case, the fixed costs are allocated or applied to each test based on the number of tests performed by the laboratory. Decisions that ensure future financial performance is an important aspect for any laboratory manager. Financial management provides a variety of benefits. First, for the patients, it provides for better quality services at a reduced cost. Next, for the healthcare administrator, it provides information for strategic planning and the best use of available funds. Finally, for the laboratory manager, it provides financial information for effective cost reductions, appropriate test utilization, equipment utilization, staffing utilization, and material usage.